Good morning, everybody. All right, looks like we'll go ahead and get started here. Welcome to this morning's presentation on profit and loss statements. So, my name is Ivan Griffin. I am with Pathway Financial Education. And so at Pathway, we offer free financial education for high school students and adults, personal financial education for them, and also business education for small business owners, mostly startup businesses. So I work with the small business owners. I do business development. A little bit about my background. So prior to getting started in business development, I spent a little time as a financial advisor. However, I am not a CPA. So we're going to cover some of the basics of profit and loss statements. However, there are a couple of sections that do involve some accounting, and so we won't take a deep dive into the accounting portion of those. Those questions would be best reserved for your CPA. Okay. So before we get started, just have to read this disclaimer here. So the information provided in this presentation are for general information purposes only and are not intended to be constituted as financial, legal, or professional advice. So always consult with a qualified professional before making any financial decision. And so before we dive into this, if you guys don't mind, we kind of like to get an idea of where you are in terms of your knowledge of profit and loss statements. And I'll give you guys just a couple of minutes to go over that real quick here, and then we'll dive right into it. Okay, so we'll go ahead and dive right into this. So again, this is going to be a pretty high-level overview of profit and loss statements. These statements can get pretty complicated. They range from the very simple to the very complicated. And so there's a lot of information that could be covered here, more than we actually will have time for. So we're actually, just going to kind of give you the basics here this is primarily for someone who does not have any experience with a profit and loss statement, someone who's brand new to this. And, so what is a profit and loss statement? So basically, this is a tool that businesses use to determine whether they're making a profit or loss. I mean, just kind of like the name states. I mean, it's pretty simple, pretty straightforward. And so income statement, profit and loss statement, they're pretty much the same thing. Those terms can be used interchangeably. So now there are three main financial statements that businesses typically use. So there's the the balance sheet, profit and loss statement, statement of cash flows. So balance sheets are also vital. You know, they list the company's assets, liabilities, and the owner's equity as of a set date. So, you know, they show whether whether a company is leveraged or not. They're also helpful when maintaining a cash flow statement, you know, which details money going in and out of a company. So a balance sheet will also show whether a company has sufficient funds to pay its bills when they come due. So for today, we're just going to focus on the profit and loss statement. And so how often would you need to prepare these documents? So, I mean, it could be monthly, quarterly, annually. I would recommend it monthly because, you know, it's good to stay on top of your finances, keep track. You know, you don't want to go too long without having an understanding of what's happening in your business. Okay, so it's not required for tax purposes, but it is something that is highly recommended by any financial professional. So profit and loss statements come in various different types. The single step, multi-step, comparative income statement, common size, variance, segmented driver base. And so that single step, that's the simplest form. And so, you know, as I mentioned before, I mean, they range from very simple to very complex. And so when you're in that startup phase, you're just starting out, most likely the single step method would work just fine for you. But as the business grows, you will start to progress to some of those other types. So the method you choose affects how the information is presented and the insights that can be gained from the statement. So understanding the various types of profit and loss statements will help you choose which is the proper one for your business. So each type has its own applicability and purpose. So factors such as, you know, whether you're doing this for internal or external reporting, or, you know, use case, the focus, whether it's backward or forward looking, and the audience that you're preparing the document for. Okay, so the single step method. So this is the simplest one to create. And so with this approach, you know, you're going to list all the revenue items at the top of the statement, subtract all expenses, and arrive at a net at an income or loss. So it just requires a single calculation. So businesses with uncomplicated financial structure are best suited for the single step method. So it provides a quick and easy way to assess profitability, you know, without breaking down the information into multiple categories. Next, we have the multi-step income statement. So this is a little more complex. So it involves categorizing revenues and expenses into operating and non-operating items, you know, allowing for more detailed analysis of a business's financial performance. So it has three different calculations: the gross profit, which is the net sales minus the cost of goods sold; operating income, which is gross profits minus operating expenses; net income, which is operating income plus non-operating items. So the additional information breakdown makes the multi-step method ideal for slightly larger businesses or companies with more complex financial structures. So it provides a more comprehensive view of the company's profitability and helps to identify areas for improvement. Then there's the comparative income statement. So in this statement, the performance for multiple periods is placed in adjacent columns. So this is the preferred format for financial analysts, and it features quarterly or annual reports. So in quarterly reports, you may also see variations of this template, which lists specific quarters' performance side by side with year-to-date performance. Excuse me. So now, most accounting software, if you use like QuickBooks or Xero, some of the other more popular accounting softwares, you can actually generate these reports. They will actually generate them for you pretty easily. Next, we have the common size analysis income statement. So this one represents all line items as a percent of a chosen metric, so typically sales. So this type of income statement is useful for benchmarking a company's performance against industry peers of varying sizes. So what you're doing with this one is when you want to get an idea of how well you're performing, you want to compare your numbers to that of your industry peers, companies of a similar size, and this helps you to be able to do that. So the variance P&L statement. So this can also be used for benchmarking. And it can be used for planning and budgeting, and for your internal reporting purposes. Like this is an example of one from Walmart. Next, we have the contribution margin P&L statement. So this is used to showcase profit contributions from various geographies, various products, or various business units. So this template is used for internal reporting purposes. So it separates variable and fixed costs. So unlike traditional P&L, it distinctly separates variable costs from fixed costs. So it gives you a clear picture of how much each product or service contributes to covering fixed expenses. So it's useful for a break-even analysis. So this statement is crucial for calculating that analysis and determining the sales volume needed to cover all fixed costs and to reach profitability. So for product profitability assessment, so managers can use it to compare the profitability of different products or product lines based on their contribution margin. So identifying which ones generate the most profit relative to their variable cost. So it's a good tool to use for your decision making. So by analyzing contribution margin, companies can make informed decisions about pricing strategies, production volume, and which products to focus their attention on. So next we have the driver-based P&L statement. So this one is a favorite of management and strategy consultants. So it's a forward-looking template. It's often used for planning and breaking down revenue and expenses into constituent general ledger accounting items. So the critical value drivers of a business are shown here. This is the composite P&L statement. So this is a type of its own. So yeah, this is one that's popular with a lot of financial analysts, to help them drive effective decisions. So now there's no single template for this type. There are a wide range of different templates here, and they vary just based on just the type of business you're in. So performance and variance is tracked across several periods, common level, grand totals, and so row level, general ledger accounts, leveraging hierarchies to drill down to several levels, which is not shown in this illustration, but so a mix of financial and non-financial metrics, such as the number of employees, production per hours, are thrown in for reference. So it reference other spreadsheets and models. Okay, so now we're going to get into how to read and analyze a profit and loss statement here, and so we're going to focus on the simplest one here, which is again what most startups are going to be using. So first, you want to determine a company's accounting method. And so you could use the cash basis method, where income is reported when received and expenses are reported when paid. Or the accrual basis method, where income and expenses are reported when the transaction occurs, even if cash has not been exchanged. Then there's also a hybrid method, which we'll touch on here in a second. So the accounting method affects how income expenses are accounted over the period. And let's see. So first we're going to take a look at the cash basis accounting. So the cash method is easy to understand and follow. So most small businesses and individuals operate on a cash basis and prepare their income taxes using this method. So under the cash method, income is recorded when payment is actually constructively received. So constructive receipt means an amount is credited to your account or made available to you without any restrictions. So for example, you receive a check in December for services you perform. You don't cash the check until January, but you must report the income in December. So because you had control over it then. So if you're paid in property or services rather than in cash, including check, credit card, or electronic transfer, the fair market value of the property or service is income when received. So under the cash method, expenses are recorded and paid to vendors for purchases of products and services. So for example, your rent is due on the 1st of the month. If you pay early, say the 28th of the previous month, that's when you record the payment. So if you pay late, such as the 5th of the month, the month that the rent is due, then that's the day the expense is recorded. Now, under the accrual method, revenues are recorded when earned and expenses are recorded when incurred. So rather than recording revenues and expenses when payment changes hands. So more specifically, income is recorded when all the events that fix your right to receive it have occurred, and you can determine with reasonable accuracy what that income is. So, for example, you fulfill an order and ship the goods. You record the income upon shipping because all events have occurred to create your right to payment, and you know what that payment should be. So you don't wait until the payment is received. So the same rules govern the treatment of expenses. So for example, your rent is due on the first of the month, and this is the date for recording the expense per the accrual method. So it doesn't change whether you pay early or late. So there's actually a test here to determine when the money should be recorded. So all events have occurred that establish the fact of the liability, and the amount of the liability can be determined with reasonable accuracy, and the economic performance has occurred. Now, there's another method, the hybrid method. And so this is allowed by the IRS under certain circumstances. However, some financial professionals don't recommend it because it's less clearly defined and more difficult to manage. So they'll allow it if it clearly reflects your revenue and expenses. You can apply, and you apply this method consistently. So, I mean, the definition is really quite broad and allows for a great deal of interpretation, which can be problematic. So, in the event of an audit. So most business owners, choose either the cash or accrual method because of that. So the key components. So there are two main parts. There's the income earned during the statement period and the expenses earned in the same period. So these two parts are divided into various entries relevant to your business. So not every P&L will have the same lines. You'll actually have to adjust it slightly according to the type of business you're in. So we'll start revenue. So revenue is reported first on the profit and loss statement. So it includes all income items. So this entry on the P&L statement can be called sales, gross receipts, fees, or any other term that describes money coming in. Okay. So operating revenue is typically separated from non-operating sources of income like interest. So again, the accounting method affects when revenues are reported on the P&L statement. So using the accrual method of accounting, revenue is reported when earned at the time of sale. I'm sorry. even if payments haven't been received, and the cash method records payments when received. So to increase the accuracy of reported income, gross sales may be adjusted based on past experience of customary returns or refunds requested by setting an allowance and subtracting it against revenues. Then we have the cost of goods sold. So a company that sells goods must first figure out their cost of goods sold. So that is the cost of inventory and any materials used to create the product, which is then subtracted from the sales to determine the actual revenue or gross profit from the sales. So for example, a company that carries a $20 item in inventory and sells it for $100 would have $100 in revenue, but report $80 in gross profit after accounting for the $20, the cost of goods sold. Then there's the expenses. So the expenses portion for large and small business encompass expenditures to operate the company. So these can include things such as advertising costs, employee salaries, benefits and payroll taxes, interest expenses, office supplies, payments to vendors or contractors, professional fees for accountants, attorneys. Accounting for some expenses requires understanding asset depreciation. So some purchases, such as office equipment, must be capitalized as an asset and written off over the useful life of the item. So for example, if a $1,000 computer is purchased and no accelerated write-off is used to account for the purchase for tax purposes, then it would be reported over 5 years. So each year, the profit and loss statement reflects 20% of the cost of the computer, or $200 in expenses. So non-operating expenses such as interest and taxes are often separated from operating expenses to illustrate the difference between the two. So understanding depreciation can get pretty complicated, and it would require an entire lesson to completely cover depreciation. So this is a resource that you can use to help guide you through how to handle the asset depreciation. And so this will give you a basic understanding of how it works, but it's still a conversation that you would need to have with your accountant. So then we have the gross profit. So if a company is a service organization without inventory, so gross profit and gross receipts are the same. So in this case, gross profit is simply the total revenue earned from service periods minus the direct costs associated with delivering those services. So essentially representing the profit made solely from the service itself. As there is no cost of goods sold to subtract since there is no physical inventory. So then you get down to the net profit or loss. You put out calculate all those numbers. So the net profit would be the total revenue minus the total expenses. That'll give you your profit or loss. So how to create a profit and loss statement. So if you want to create one manually, so the process is slightly more involved and time consuming. To simplify the task, you can use a template, but we'll kind of go over step by step. So the easiest way is, your accounting software, your QuickBooks or Xero, whatever you use, can actually generate these for you. So first you choose the reporting period. So the P&L is going to provide a financial snapshot just during a particular period. So you want to decide whether you're going to do it for monthly, quarterly, or annually. Then gather all the financial statements, locate all your necessary details, your revenue, your expenses, invoices, receipts, credit card statements, bank transactions. So add up all the revenue, list your sales to determine your gross revenue. Then you can break it down into subcategories of sales if it's necessary. List your cost of goods sold to do that. And then subtract that from your gross revenue. So this amount will give you your gross profit. So then you want to record your expenses, create categories for each type of expense. And you remember, you don't include interest in this step. We'll account for that later. You figure your EBITDA. And to do that, you want to subtract the total expenses from your gross profit. And this is your earnings before interest, taxes, depreciation, and amortization is what EBITDA stands for. And calculate your interest, taxes, depreciation, amortization, and list any interest you may have on business debt, taxes, or net income. Usually estimated, since the P&L is likely being prepared before filing your tax return. And depreciation and amortization expenses. Okay, so then determine your net income, subtract the interest, taxes, depreciation, and amortization from EBITDA. Okay, so we're going to look at an example of a P&L statement. This is for a business called Specialty Cakes. So this is a part-time home-based business. So his revenue for the year is $5,000. His cost of goods sold, which is like his flour, eggs, etc., is $800. So his other expenses include boxes for the cakes, car expenses to deliver the cakes, advertising, insurance. So his P&L for the year, this is a year-end P&L, will look like this. So this is the simplest form, pretty simple and straightforward. Just all of that data that we have recorded in other places, you just take all that data and just plug it in, and then do your calculations here, and you arrive at the end there with a net profit of $13.25. So analyzing the profit and loss statement. So business owners should use the profit and loss statement to understand first if their business is profitable or not, or on the path of profitability. So comparing your P&L statements quarter over quarter and seeing an increase in revenue may indicate an increase in demand for the product or service. So a decrease in cost of goods sold over a period of time may indicate that the business is becoming more efficient. So if operating expenses are keeping a business in the red, it may be a signal to a business owner that they should look to cut costs in some areas. So if a young business isn't showing a net profit on its P&L, it doesn't necessarily mean trouble just yet. In the early days, businesses have to spend more money to make money. So as they achieve, as they start to scale, and ideally their cost of goods sold starts to go down while revenue goes up and they start to turn a profit. So there are a couple of different ways to analyze a P&L statement. There's a vertical analysis versus the horizontal analysis. So in horizontal analysis, which is also known as series analysis, so this looks at changes over time within a particular line item. So for example, to calculate the percentage that revenue increases year over year for 5 years, horizontal analysis helps you to see patterns such as cyclical occurrences and detect red flags, such as like your cost of goods sold are too high. So vertical analysis is also known as common size analysis, and it focuses on the relative size of expense items compared to a company's revenue. So for example, how much is a company spending on marketing or research relative to its revenue, and how this is trending over time. So another thing that you can do with this is to calculate the profit margin, which is going to give you a percentage here. So net profit margin is the net profit divided by total revenue times 100. So you see from our earlier example with the cake company, so the profit margin was 26.5%. So what you want to do with that is do a little market research and determine what your peers are doing, what are similar businesses in your region that are similar in size and in terms of product and services. Take a look at what their profit margins are, and then use this here to compare your performance with theirs. So, the P&L is a crucial document because it provides clear and concise snapshot of a company's financial performance over a specific period by summarizing revenue, expenses, and ultimately profitability. So it offers valuable insights as to the health of the company. So it also helps with pinpointing potential improvements, such as curbing expenses or channeling focus towards more lucrative products or services. So it's also something that's important to investors, lenders, and other stakeholders when assessing the business's financial stability and potential growth. So you use it for a couple of different purposes. There's the external purposes that you're going to use for potential funders, and then there's certain versions that you will use just for your internal reporting and planning. And there you have it. There's just our basic high-level overview of profit and loss statements. And And if you guys don't mind, and another quick survey here at the end. All right, if you guys got that completed, that wraps up today's presentation. Any thoughts, questions? Sure. When determining like which version to use, well, it's not consulting their team of professionals like their CPA. I see a lot of startup business owners, just trying to figure it out on their own without the use of professionals. I would say that would be the biggest thing. To find one, so there are a number of sources, such as like 1-800-Accountant or something. There are a number of resources out there to help you with your accounting needs without having to hire a full-time accountant. Sure. Yeah, I would just use the QuickBooks Online, sir. All right, so if there aren't any other questions, I think that wraps us up for today. So thank you guys for coming out.